Good day, everyone. I know that for the folks who are invested in cryptocurrencies, you should be going through a fairly painful time right now with the crash of the Terra Blockchain. So for today's session, I'm going to talk about the painful lessons, right, that has been learned from the collapse of the Terra Blockchain. My name is Christopher Ng and I'm the Dr. Wealth trainer. All right, and let's begin with an overview of what I'm going to talk about today. Our Terra USD or UST is an extremely popular stablecoin that is supposed to be pegged 1-to-1 to the US dollar, and on May the 9th, 2022, it depegged. All right, so it was no longer worth $1 US, and panicking investors began to exit the blockchain in droves, and this created a collapse of not just the stable coin, but the Luna coin that is actually related to the UST currency. So right now, the UST currency has dropped as low as 5 cents when I was creating the slide, and it's actually slightly below 1 cent today. All right. Now, we will try to come up with an explanation on why this has happened, and then we will try to derive some of the lessons from the fallout, and I will try to speculate on the future of the Terra blockchain. All right. Okay, so very clearly, right, if you look at the graph that I've shown you on the chart, the UST began to depeg in May. All right, and when the depegging of a currency has occurred, it introduces something that's very, very similar to a bank run. Okay, and people would start to trade off their UST currency, all right, for actual US dollars. All right, so hence generating a panic. And the currency that's associated with the Terra USD Luna has had it even worse. It was $100, I think, sometime in April, and in May it is already worth a fractions of a cent, right? 0.0004 to 5 cents. Okay, so what likely happened? Okay, now it seems from the news that someone was deliberately trying to break the peg. Okay, somebody detected that some of the US Terra coins were taken out of a platform called Curve, and sensing that liquidity was very low and weak, someone then dumped the currency in an attempt to break the peg. All right, Terraform Labs later clarified that the reduction of liquidity in Curve was meant for redeployment into this thing called a 4-pool a week later. But that being said, right, Humpty Dumpty has already fallen. Okay, and if a stable coin can be brought this low, okay, by a single party, then it is clearly not as stable as investors would like to think. All right. So there are certain lessons that we can draw from the crisis. This fallout has led to people saying that all stable coins are Ponzi schemes. All right. Yeah, and I think that there are 4 major lessons that we can learn. The first is that algorithmic stable coins are unstable. The second lesson is that collateralized stable coins are still holding up, although barely for some. Okay, and the third lesson is that diversification between different coins remain very crucial for cryptocurrency investors. And finally, traditional assets still matter. All right. So let's go to the first lesson. The first lesson is that algorithmic stable coins are unstable. Okay, now the initial excitement, right, about US Terra is that it's possible to build a stable coin without putting up collateral. And the idea of doing this, the idea of creating stability for US Terra is that it has to come at the expense of a speculative mirror currency called Luna, right, which was actually very brilliant when it was working, but it didn't survive reality. Okay, so basically the value of Luna crashed, and it became very much harder for people to arbitrage between US Terra and Luna. So some of the points I want to make is that algorithmic stable coins are inherently unstable, so they need to be viewed as speculative instruments. All right, highly likely that regulators around the world might not even allow algorithmic stable coins to gain prominence moving forward. Okay, now if you're going to play stable coins, then allocations need to be very small, and if possible, insurance need to be bought. All right, and there has to be an exit plan to get out while the going is good. Right, so right now, while algorithmic stablecoins are no longer as popular as before, people are still talking about other algorithmic stablecoins like USDD in the Tron blockchain. All right, so this is something you need to think about if you're putting money in these stablecoin yield or lending kind of platforms. All right, the second lesson is that collateralized stablecoins are still holding up. All right, while algorithmic stablecoins are inherently unstable, there are classes of stablecoins that are backed by collateral that are actually comparatively more stable than algorithmic stablecoins. Some, like USD Tether currency, USDT, are backed by fiat currency and treasury bonds. Others, like the DAI coin, DAI, are backed by 200% of cryptocurrency, okay? And these currencies are able to retain their peg and have been holding out so far, right? But likely what will happen is that the fallout in the Terra USD will force other stablecoins to take steps to prepare for more regulatory scrutiny, which will ultimately be good for investors. All right. Some of the stablecoins that are still up and running include USDC, USDT, GUSD, and DAI. All right. And USDT on FinBlocks continue to yield about 12%. All right. I put 15% on my slide, but it's been recently revised to 12%. And you have to have this understanding, right, that yields above 10% are generally unsustainable, all right? But I think the trick is to enjoy it while it lasts. So right now, we are looking at Gemini USD that you can have for 6.9%, okay? And FinBlocks allows you to put in your USDC and DAI at about 12% and USDT at about 9%. The third lesson is that diversification between stablecoins remain crucial, right? Now, as US Terra crashed from $1 to about 5 cents and now to about less than 1 cent, investors need to be prepared to have stablecoins crash towards almost zero value. And this is certainly something that is no longer a remote possibility. And so the best way of defending yourself from this kind of depegging is to split your money between different stable coins. So there are 4 stable coins discussed in my presentation. So USDC, USDT, GUSD, and DAI. So what you can do is that a crash in one currency will jeopardize at most 25% of your cryptocurrency portfolio. And as more stable coins begin to appear and you add them into your portfolio, it will make your portfolio comparatively safer. All right, and so on top of having a portfolio of stable coins, when the rest of the cryptocurrency world were to recover, you can slowly add positions on Bitcoin and Ethereum to diversify your portfolio even further. Okay? And so equal weightage between stable coins remain very crucial, okay? And tactical allocation to Bitcoin and Ether can be built up over time. All right? Although this has to come with the proper technical signals. The fourth lesson is that traditional assets still matter. The folks who survived the Terra fallout had traditional assets that have a low correlation with cryptocurrency. And this is the safest way to preserve your wealth while still being able to capture the upside of cryptocurrency. So traditional assets generally consist of stocks and bonds that give about 7 to 9% returns over the past 10 years at a standard deviation of about 12%, right? If you limit your allocation to cryptocurrency to about 10%, consisting about 4 stable coins or maybe 2 very, very commonly, very popular crypto like Bitcoin and Ethereum, then what you can do is you can limit your expected loss on a depegging event to less than 2.5% of a portfolio. And this is very, very important because you really don't want to put all your eggs into the cryptocurrency basket, all right? And when you put your money into crypto, right, make sure that it's money that you can afford to lose, okay? So follow this rule of capping it at 10% of your net worth, okay? And even better, you can ensure that the cryptocurrency and commodities allocation share the same allocation that is capped at 5%. We will now discuss the future of the Terra blockchain. At the moment, it is highly unlikely. Okay, at the moment, it's highly likely that by 27th of May, Terra would have already rebooted itself into a new and different blockchain. Okay, And the reason why there is a new Terra blockchain is to preserve the ecosystem of developers who have invested time and money to develop these platforms on Terra. All right. So what happens right now moving forward is that there are two blockchains. There is a Terra blockchain that actually contains a new Luna coin. There is also a Terra Classic blockchain where our older US Terra and Luna Classic coins is to reside on. Okay. Now investors should not get their hopes up, as Terra is widely seen to be worthless without a stable coin like US Terra and its ecosystem. Okay, so in summary, the collapse of the Terra blockchain has dented the credibility of cryptocurrency as an asset class and has led to the destruction of fortunes among many investors. The most painful lesson is that algorithmic stablecoins, while brilliant, are unviable in practice. Stablecoins collateralized with fiat or crypto seems to have held up in this event, but there is nothing to say that they won't depeg in the future. If you're interested in yield farming these stablecoins, then you need to spread your investments among different platforms as well as stablecoins. Hopefully, crypto investments should be backed 9:1 by traditional assets. All right, so this limits the losses that we have, okay, and it ensures that a depegging event will not eliminate your entire net worth. All right. Now, if we look at the current state of the Terra blockchain, it will be very difficult for the new Terra blockchain to recover from this depegging event. The loss in trust is probably something that is very hard to reverse itself, and the best that investors could do is to move on from this event, hopefully a little bit wiser. Okay, and that is the end of my presentation on the Terra blockchain. Thank you very much.